Charlie Munger was asked at one of the Berkshire annual meetings by a young man, how can I get rich? And Munger's response was very simple. He said, if you consistently spend less than you earn and invest it in index funds, dollar cost average, because you're putting in money every paycheck. Mm-hmm. He said that in about 20, 30 or 40 years, you can't help but be rich. It's just bound to happen. And so any individual investor, if they just put away 5, 10, 15% of their income every month, and they just bought into the low-cost index funds, and just 2 or 3 of them, just split it amongst them, you're done. There's nothing else to be done. Now, if you go to active managers, the stats are pretty clear. 80 to 90% of active managers underperform the indices.
Over the last decade or so, ETFs have been the most popular way for passive investors to compound their hard-earned cash, and for good reason. It's cheap, it's simple, and historically it's performed very well over the long term. Due to the explosion of exchange-traded funds over the last few years, there's now hundreds of ETFs in every category of the market, and it can be a bit confronting for new investors trying to narrow it down and decide which ones to invest in. Now, due to ASX guidelines here in Australia, I can't provide advice on which ETFs you should buy, but what I can do is break down 5 common categories of ETFs with a few examples for each group, just so you know what choices are out there and what the key differences are. So that's the topic for today's video, and let's get into it. Alright, we'll start with the most common type of ETF on the market today, and those are index ETFs. Index ETFs usually have a pretty simple investment objective: to passively track a broad market index, such as the ASX 200 in Australia, or the S&P 500 in the US. In Australia, an index that's pretty common to track is the ASX 200, which holds the top 200 companies in Australia by market cap, and accounts for around 81% of Australia's total equity market. Now, when you have a broad market index like the ASX 200, there's probably going to be a bunch of ETFs that passively mimic that index from many different providers. If we take the ASX 200 for example, there's at least 3 ETFs that passively track that index. One from BetaShares, one from BlackRock, and one from State Street. And if we looked at the holdings for all 3 funds, they'd look pretty much identical. So how do we compare ETFs? The easiest way to compare ETFs that have virtually the same holdings is to look at their management fees or their expense ratio, so you can figure out which ETF is cheaper to own. Most ETF providers have their fees clearly listed on their homepage, so it's pretty easy to distinguish between providers. But it's important to note that not all providers are honest and transparent with their fees. Now and again, a provider will have their fees listed, but it will only show the management fee and leave out all the extra fees that get added on. The best way to be 100% sure about fees is to read through the product disclosure statement for whatever ETF you're looking at, and having a close look at the fees section so you can figure out exactly how much you'll be charged. Some ETF providers occasionally have to restructure their portfolio, and sometimes they pass on the extra fee to investors. So no matter what type of ETF you're looking at, whether it's an index ETF or something else on the list, always pay close attention to the fees. And personally, I'd stay away from funds that have fees of 1% or more. Alright, the next type of ETF one can invest in is an actively managed ETF, where the aim of the fund is to outperform the general market over time. And an example of an active fund would be something like ARK Invest's ETFs. The idea behind active ETFs like ARK is pretty simple. I paid them more in fees, and in return, they make me more money by picking above average companies and beating the market. The problem with this scenario is that me paying high fees is a certainty, whereas them beating the market is definitely not a certainty. And as a whole, fund managers don't exactly have the best track records when it comes to beating a passively managed index. In Australia, over a 15-year period, only 17% of active funds outperformed the ASX 200. And in the US, only 10% beat the index. So there are outliers, but in general, active managers don't have the best record of beating a passive index. And for the average passive investor who doesn't want the bother of picking and choosing individual stocks, I feel like picking and choosing individual active fund managers is sort of in the same wheelhouse. If you're trying to figure out whether a fund is actively or passively managed, just read through the fund's overview, and if it says something like tracks a benchmark index, then it's usually passively managed, and vice versa for actively managed funds. Alright, moving on to number 3, I have commodity ETFs. These are pretty self-explanatory, and they basically track various commodities such as gold, silver, oil, and natural gas. Now, I personally have no competence whatsoever when it comes to commodities. I know nothing about oil or gold, so it's always been a part of the market that I've stayed away from. But if you have some knowledge or experience in that area, like you know a lot about oil for example, or just commodities in general, then it could be something for you to look into. Alright, number 4 on the list is property ETFs. And before I get into this, I need to explain something called REITs. REIT stands for Real Estate Investment Trust, and it's basically a company that owns and operates real estate to generate income. Just like regular public companies, investors can buy shares in REITs, which represent part ownership in the individual company. So for simplicity, we can think of a REIT as an individual company, just like Apple or Google. And in the same way that an ETF is a basket of stocks, a REIT ETF is simply a basket of REITs, and they often passively track indexes for the larger real estate market. An example of something like this in Australia would be VAP, or the Vanguard Australian Property Securities ETF, a REIT ETF that seeks to track the return of the ASX 300 A-REIT index, which is an index made up of the top 300 REITs in Australia. Something to note with REITs is they have a requirement where they have to pay out at least 90% of their income out to shareholders as dividends. So these ETFs aren't really the best choice for investors who are looking for capital growth, and more for investors who are trying to generate income with their investments. Again, if you have some knowledge or competence in property and real estate, then REIT ETFs could be something for you to look into. Alright, last but not least, coming in at number 5, we have dividend ETFs. In Australia, because the overall market is heavily weighed by dividend paying companies, some of Australia's broad market ETFs, like the popular VAS, could be considered dividend ETFs, as they have high yields of more than 5%. But there's also ETFs out there that focus purely on dividends, and they can be both actively and passively managed depending on the fund. An example of an actively managed dividend ETF from the ASX would be something like the Australian Dividend Harvester Fund from Beta Shares, which is a hand-picked portfolio of around 50 Australian stocks and ETFs, and it charges a pretty high fee of around 0.72% per annum. And for a passive dividend ETF, a good example would be something like VHY, or the Vanguard Australian Shares High Yield ETF, which is a passive fund that tracks the return of the Australia High Dividend Yield Index. This ETF has around 70 holdings and charges a fee of around 0.25% per annum. And these are just a couple of examples from a long list of ETFs from various providers. So overall, I think passive investors have a lot of choices when it comes to investing in ETFs, and the road you go down kind of depends on what your investing strategy is. Once you decide what your strategy is and what your goals for investing are, it'll probably become clear what ETFs you should be buying. Like I said before, I can't give recommendations on what you should buy, but if you have any questions or you don't quite understand something, then let me know in the comments below and I'll do my best to help you out.
What criteria would you use or recommend to select an appropriate index fund? Second, the price to earnings ratio of the S&P 500 is significantly higher than its historical average. What benchmark should an investor use in purchasing this index?
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30 year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved, because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results. And I recommend to all of you reading John Bogle's written a couple of books in the last 5 years, and I can't give you the titles, but they're very good books, and anybody investing in funds should read those books. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. The important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
If you enjoyed the video and you want to support me, please consider hitting the like button, as it really helps the channel grow. And if you watched the video all the way to the end, thank you so much for watching. If you're not seeing my videos yet, I'll put another video up in the corner that I think you might like. So that's it for this video. Thank you so much for watching, and I hope to see you guys back in the next one.